In this video, we are going to look at how to grow a small trading account. This is part of a series of videos aimed at teaching you how to trade using price action. The playlist is available on the Decisive Trading YouTube channel. Please like the video if you find the content useful and subscribe to be kept up to date with future releases. When most people start learning to trade, they do it with a small trading account. The idea is then to grow that account into something that will allow them to withdraw regular profits. There are two ways that people go about trying to achieve that. One involves high risk and a determination to do it quickly. The other approaches the market with caution and understands it is a long-term process. Which approach do you think ends up as a statistic in the 80% of retail traders who fail to ever achieve consistency? So let's run through the process of growing a small trading account. The first point is to accept that you have a small trading account. That may sound obvious, but so many people ignore that key point completely. You must accept that you are not going to be making any sort of income you can hope to live off of for years. And usually at this point, the majority of people think, this guy doesn't know what he's talking about, I'll do it fast. As you start to learn to trade, you must be willing to take the correct approach from the start. One approach is short-term thinking. They want to be a trader now with minimal effort. They see other people making large amounts of money and don't appreciate that it took those people years to master their craft. They believe they can grow their account fast, taking huge risks, and then trade properly later. At the end of the couple of years, there will be two outcomes. The high risk approach will be no further forward. They will have blown multiple accounts. It will have cost them a considerable amount of money. And they will still be convinced they can do it fast and be overnight millionaires. The sensible approach will grow their account slowly. They have a much better chance of achieving their goals. At the end of the couple of years, they have a larger trading account. Number 2 on our list is to learn the basics and prove consistency safely. You only have a small account, and that account is your means of trading. You can learn the basics on a demo account and make sure you have a trading plan and can execute it in such a way that leaves you profitable over the long term, a few months. By doing it this way, you give yourself a good chance of holding onto your money when you go live. A huge component of trading successfully is learning to manage your emotional response to uncertainty. If you do not know how to trade your plan properly and are suddenly dealing with the stress of a live account, you are setting yourself up for failure. When you are a beginner with a small account, it is always best to learn safe. The likely outcome of jumping straight to a live account is losing your account and having to start again, which will require refunding the account. The third point to help you grow a small trading account is to risk small. Again, this is contradictory to the risk big to make big attitude, and there is a reason professional traders follow the small risk approach. Instead of thinking that if you risk 10%, 15% or 20% of your account on any trade, you'll double your account really quickly, risk small and build slowly. Allow yourself the room for mistakes and runs of losing trades. If you risk 10% of your account per trade, your account is gone after a run of 10 losses. But worse than that, it encourages emotional trading. Losing 10% of your account at a time is tough to take. It can cause further mistakes. That is what then usually leads to the 10 losses and wiping out your account completely. Risk small amounts. Ideally, no more than 1% to 2% of your total account per trade. That can be difficult with a small account, as your broker will have minimum trade sizes. So risk as close to 1% or 2% as possible until your account reaches an adequate size. How to work out 1% or 2% of account size. Multiply your account size by 0.01 for 1% or 0.02 for 2%. So, £5,000 account times 0.02 gives us £100, which would be a 2% risk on the £5,000 account. £3,000 account times 0.01 equals £30, which is 1% of the £3,000 account. Now for number 4, the true secret of trading, and that is compounding. And we will look at a way to speed up the process. Compounding occurs as a trading account steadily grows. Let's say we look for 4% growth per month, and we reinvest all of our earnings back into our trading account. Each month you look for a further 4% growth, and each month your starting capital is more than the previous month. So the growth in monetary terms is larger. Think of a snowball rolling down a hill. As the snowball increases in size, it gathers more snow on each rotation and seems to grow faster. So if you start with, say, £5,000, after the first month of 4% growth, you have 5,200. You then start with 5,200 in month 2 and again look for 4% growth. At the end of that month, you have 5,408, which is a £208 growth rather than the £200 from the month before because of compounding. At the end of 12 months, you would have £8,073. Within 5 years, you would have £54,896. Within 10 years, you would have over £600,000, starting with just a £5,000 account. You can see compounding seeming to make a bigger impact as you go along. The power of compounding grows as your account does. It is important to note that your risk per trade of 1% or 2% never changes. You still trade safely. But each month your account has grown, so the 1% or 2% risk is also larger in terms of the money per trade. Do it the way that works, the way the professionals do it. Let compounding do the work. And you can also give it a helping hand. You can boost your account each month. With a small account, small deposits make a huge difference. Only deposit when you have good trading months, where you have traded well and followed your plan. If that does not happen, do not deposit, because likely you will just continue to lose money. Build your account. Don't throw it away like 80% of retail traders do. Prove to yourself you can do it before you add any money to your account. Reward good trading, not bad trading. Each time you do, your compounding will have a bigger impact. Think of packing snow onto the snowball even as it rolls down the hill and collects snow itself. So, accept that you have a small trading account. Learn the basics and prove consistency safely. Risk small. And let compounding build your account rather than by taking huge risks. Hopefully you found this video helpful and it has given you some useful information on how to grow a small trading account. If you enjoyed the video, please take a second to hit the like button. Subscribe to be kept up to date on future video releases.